Welcome everyone on this webinar from One4All Group about investment model. With this webinar, we just like to share our investment model that we do for listed, even though we have here at the event people present from the startup space. We believe that investment in listed companies is something that is, necessary or basic, or as a base thing for all. Therefore, we are opening up for new members in our basic plan, which I will tell you a bit more after my partner Eric does the presentation about our investment model. And yeah, I hope you enjoy this information and you put it to use for your own personal or professional use, and you find it interesting. Yep.
Okay, good. See, in a way, I think what's important is that as an entrepreneur that you understand the thinking of investors, and it's one or the other way, always something that is very structured. And it's not a coincidence that traders, brokers, investors, chess players, mathematicians, think about quantitative investment strategies also, that they have something in common. Because in the end, markets move quite erratic from day to day. There's a lot of noise. And the only way in which you can generate good returns in the long term is to somehow structure it and learn from the mistakes that you've made. And the moment that you do that, you literally will always be interested in interesting opportunities, be they listed, be they non-listed. So the moment that you bump into one of those opportunities as an investor, or the other way around, the moment you literally find an investor interested in your firm as a non-listed company, yeah, it's literally trying to convince each other of the return risk profile and that it will add value to the portfolio of the investor. So structure is not in this case about that I want you to buy my model or give me money. I'm not open as an asset manager. It's more about trying to explain the background. This is from, the picture is from 20 years ago with Harry Markowitz when he visited me in the Netherlands back then, and we started working on the papers on the asset management approach that could also incorporate situations with scarcity in information. So, yeah, every year since then, what I have been doing is sticking to the approach and use it myself. And learn from mistakes. And the latter is, I think, very important. You can learn far more from the mistakes that you made than from things that work well. And I have a little example to show you why that is the case. But the problem is, for you as an entrepreneur and for investors as well, the moment that you live in a market where literally things go up and down, you have price signals, you have short-term information, you have long-term information, economic information, political information. How can you somehow link them all together in a structured approach? That's the problem. See, it's easier said than done to have a structure. And as an academic, when still a professor, I saw a lot of students with fantastic approaches. They worked out the most amazing models. And then I asked them, okay, this is nice. I can see that you can write it down in a Word document, but the moment that you would like to update it, do you have the time, the resources, the people to update it regularly? Or can you just now write it down because, yeah, you were writing a paper as opposed to using the things that you were writing about in your strategy? So literally, you need to know yourself and you need to know your investor as an entrepreneur. What works in the market and what someone is looking for. So remember there, markets are always looking for the truth. Price is not the truth. Value is the truth, but value is what we cannot see. So when you, as a non-listed entrepreneur, have a discussion with an investor, he comes up with a bid and you come up with a price that you have in your head for the shares. You both are doing a valuation, and you communicate to the other the valuation in the form of a price. But price is not equal to value. When you have a good, efficient market, price will fluctuate around value. But yeah, sometimes it's higher, sometimes it's lower. And basically, as an investor, you make a sport of a life where you try to find valuable things that have a price below value, and you try to sell them when the price is far above value. But you never know exactly when you're right or wrong. And that's difficult. And the only way to find if you're right or wrong is when you have structured your information in such a manner that you can later ex post compare what happened with what you expected up front. And that can be a very lovely exercise when markets move in the right direction, like in my case now with the gold in the last couple of weeks. But it can also be a pain in the ass thing when you are losing money and things go wrong. But the essence is that you have to do it in both cases, and you have to continue. And I've seen so many investment clubs or family members that love the whole thing when markets are good, and the moment that markets turn sour, they lose interest. And that's also wrong. So literally, you need to be in the market all the time. How does that apply to entrepreneurs? Well, I meet a lot of entrepreneurs that the moment that they're looking for money, they try to find the money, but they don't realize that it is not necessarily exactly the right moment to find the best investor for your company. Investors are all the time looking for new opportunities, even when at that moment they don't have money free. So that literally, the moment that you build a relationship with investors, the moment that you have something exactly at the time when they have money free, that will create a match made in heaven. But the problem is the asset managers normally always have money free, but they're tricky guys to deal with, as I explained. But the investors, the other way around, normally they don't have idle money. Money is always used for one or the other investment. But because whenever price is higher than value, they try to sell, the probability of them just selling things when you are around with your opportunity is pretty much there. But you can only get in that situation when trying to build a relationship, a longer term relationship, even when there's no money directly needed with investors and investors. That's already a pretty subtle difference there. The moment that you try to structure, you always need to incorporate that there are more factors, top-down factors related to the market, there are sector-related factors, and there are company-related factors. And they all are important. If you want to specialize in one or the other component, it won't work. I see a lot of small company pitches to our family office, to other family offices, where literally everything talks about the company. But the smaller the company, the less likely that you can basically ignore the market or the sector. See, when you are so big that you kind of make the market and make the sector, you will probably also have the financial resources to literally not bother about them too much. But to use a Nigerian example, 1.5 years ago, we had some discussions about an investment that we could make in a financial company, interesting startup in Nigeria. And we were talking two languages. I liked what the guys were doing and they liked it, but still I was the pain in the ass for them because my problem was the market factor, the Naira, because they wanted me to pay USD and I was worried about the Naira. Well, everybody who followed Nigeria this summer knew exactly now what my problem was 1.5 years ago. problem was not those guys, but if I pay the guys in dollars and the guy do their work in naira, how much naira will they have, and how much will it be in dollars after something goes wrong in the market? And countries like Nigeria, Turkey, Argentina, etc., they struggle with those situations. And it's nice that we have now Muriel from Brazil, because Brazil is one of those few examples of countries that somehow were able to switch from a currency situation that was long-term very bad to one that the last couple of years looks a lot better. China did it before, but it's very, very hard for emerging markets to overcome a lot of the monetary issues and step by step make it a little bit calmer in top-down space. So the smaller you are, the more you need to incorporate the three components into your whole story. So the moment that you are from a bad currency country, you need to automatically think about market factors when talking to investors who come from good market countries. So take the ultimate example, Swiss investors. The Swiss franc is the strongest currency in the world, no doubt, long term. The moment that you ask a Swiss investor, hey, invest in me, and he knows that you are in a country where, by definition, every year the currency loses a little bit compared to the Swiss franc, you also have to convince him that he will make some extra return over and above what he can make in Switzerland when investing with you. So you already need to think, where is my excess return for that investor, even though you didn't talk about the company itself yet. So the moment that you analyze what am I going to tell to the investor, you need at least some information about each of these components to really convince the international investor that you have a great thing going on. The good thing is that I'm not at all saying that I'm only interested in great currency situations, because a bad or a not so good currency can also help you in export markets. So basically, diversification over markets is always there. Even if I'm in the strongest market in the world, I still need to globally diversify, because every market can work against me. And a strong currency, for instance, can work against me in that nobody wants to buy my products because they're too expensive. Take in Switzerland, Liebherr, they're a white good, household good producer, refrigerators, etc. But their problem is that compared to even the German producers, they're always expensive. Why is that? Well, it's not their mistake. It's because they're from Switzerland. And being from Switzerland is expensive. And they're not necessarily better fridges than the ones that you can buy in Germany. So in a way, there is always a plus and a minus in markets, and you need to incorporate them all. Also, be careful of gurus. I have a little example here. One of the things that always, when you deal with not so good investors, or when you read information about investors, can lead to you totally mistaking the situation that you're in. I made a little example. It's a dice-based investment experiment. Suppose that I want to start up an asset management firm, okay? I did it, so I know a little bit more about it, and now I'm going to say to you, let's do it together. And I have a little trick experiment, and we're going to create an asset management firm, not immediately being out there in the market. Nope, that's the good thing that I have the time to wait a little bit, so I can work a little bit, 10 years in this example, on first making sure that I have a story no one can refuse. Okay, here it is. It's based on dice. I don't need to work on research. It's just the dice. And my dice-based strategy is very simple. I buy the MSCI All Country World Index with 5 times leverage when my dice experiment gives me a value of 1, 2, or 3 on December 31st. And if that's the case, I buy the MSCI Acqui with a leverage of 5. If I have 4, 5, or 6, I go gold, long, 20 times leverage. Okay? You might think, what is he going to do here? And then I say, I have 1,000 friends, or I have a little Excel sheet where literally we're going to play this thing 1,000 times. So I have 1,000 investment specialists working for me. Sounds already like a firm, right? Wow, our 1,000 analysts. Woo, they're working hard. Now, see what happens. After 1 year, because of the probability of throwing 1, 2, 3, 4, 5, or 6, I probably have 500 winners left from the 1,000, because 500 threw the wrong number, because markets will go up or down. So the gold strategy will do well, or the equity strategy will do well. The second year, I'm down to 250 full winners. And it takes 10 years before my group of 1,000 frauds, because none of them was working on an investment strategy, before that group is down to one guy or girl who won against the market every year in a row. But as you can remember, because I built in leverage in my strategy, this guy after 10 years is so fucking rich and so successful that a lot of people will think, wow, he must know it. He must be fantastic. Because how can you otherwise be so rich? Well, you can be so rich because of the leverage, and because this is the one guy out of 1,000 that was right all the time. This has nothing to do with a good strategy and a good product. And this is why I always love regulators. It's good that there are regulators around in the financial sector, because this is how easy it is to build a successful asset management firm. If there wouldn't be any regulators, yeah, everybody could do this experiment and score fantastic in the market. The other way around, why do I tell you this? It also means the other way around, that if you meet someone who is successful and shows you that he did great in the last 10 years and is rich, what does it mean? It means nothing, because you didn't speak with the other 999, right? And the problem is, in markets, the one who is successful, the unicorn as an entrepreneur, or the top big asset manager as an asset manager, or the big family office as a family office, the ones who were successful like to talk more about what they did than the ones who failed. But in the end, the market consists of failure and success together. And the average of these two is what the market is about. And that is a very big risk whenever you're dealing with either investors or entrepreneurs. It's about the average, but most people, yeah, have distorted averages in mind, because the good guys, the successful guys, talk more. So in the end, whenever you want to do a structured approach to valuation or to investment, you need to somehow create an approach where all the relevant factors, company, sector, macro, risk, in your model are combined in a manner that incorporates all elements, at least to some extent, and to an extent where you know upfront that you can follow that approach, that you have the discipline to continue with it. See, if you are a big bank or a big asset management firm or a sovereign wealth fund, yeah, technically you have the staff to update whatever you do every day, every week. Is that interesting? Maybe not so much. But the smaller you are, the more important it can be to keep track of these factors. But you can never do it that frequently, and you don't have to. But the moment that you learn the language of the investor and update investors regularly about your company, about your sector, about macro factors and what they mean for your company, and about the risks in your market, in your company, etc., you literally have created a model that is in a way explaining to the investor what you are about. And the more useful the information and the more structured the information that you have created, the better your model fits or aligns with what the investor is using him or herself. So this is a very, very general, very elementary way of looking at the thing, where in the end, investors and entrepreneurs belong together. The investor is just a guy that specializes in one part of the entrepreneurial task, namely the one that is about the funding related issues. So it sounds relatively easy, and that's what I always felt, people underestimate. It's not so easy. Huh? You have to update regularly. And it's easy to think about one or the other structure, but will you be able to have the discipline for the updates? Another pitfall, people, like what I told, people love it when markets are good. I could talk for hours today about my last 3 weeks in the market. Yeah, logical, because it was very successful, but it's boring. I can tell you about great success, but yeah, it's far more interesting to tell you about the great bad periods that I had in the market. 2007, 2008 was not so nice. 1999, 2000, the year 2000 issue, 1987, October, those kind of periods are far more interesting. How does the model do in a bad period? In a good period, everybody can make money. So are you willing and do you have the mindset to be out there all the time? So suppose that you are in a country where something bad is happening. You still will work in your startup. Do you have the guts to continue your communication with the international investors that you are in contact with, even when your news is not that good? Actually, that's the period when you make your friends for life, not the period when everything goes well. That's the, see, asset managers, yes. The moment that your growth is 2 times higher than what they expect, and they expect already ridiculous growth, that's the period when they like you, because they only sell the growth percentage of the average of the portfolio companies they have to the limited partners who don't want to hear the details. And they just want to get this one unicorn. But the unicorn finding is like this one guy out of 1,000 in my example. So another thing, how doubtful are you about going in the direction that you have to go into? Well, you are entrepreneurs, so I think that in general, the mindset of entrepreneurs is that they are not very doubtful people. I mean, they do have the guts to go for their dream. But you also have people that whenever there is new information that is a little bit different from the model-based approach that they had, they immediately start doubting. So if you have that kind of mindset, you will not be a good entrepreneur, you will not be a good investor. So you have to stick to your approach. Be also willing to admit that your approach is not sacred. It's not like a holy book that exists for a long period. You have to update it. Whenever there's information that no doubt says you have to change, then change. But don't immediately, whenever there is some signal in the market that says this was wrong, don't immediately throw out of the window your approach. Don't do that. Then it becomes ad hoc chaos. Learn something about probability theory. That's also important. And apply it to yourself. Like in the example that I gave, with 1,000 different pieces of information, in an investment strategy, you need 10 years to find out that there is still this one guy outperforming, but it doesn't mean anything because the next year, this one guy also has a 50-50 chance that his dice will go well or not well. And last but not least, diversify. Do it as an entrepreneur. Don't concentrate too much on one thing where the moment that it goes wrong, bam, your whole firm goes wrong. That's exactly what investors do. They try to diversify between a couple of things that they have going on. And the moment that that's the case, they reduce their risk without hurting the return. So like this, you need literally 4 different sides of the coin to be included in your model-based investment approach as an investor. And as a company, you need to make sure that you provide the investor with information about those 4 components. Market climate. Do you live in a bullish or a bearish situation globally or in your country? Sector and country information. Why is your country or sector doing well? But you also need to classify into sectors and countries because you want to compare. Like the example that I gave. Can I compare a Kenyan online supermarket with information about big US supermarkets? Not that great. Easier to compare the Kenyans with the South Africans or let's say the Middle Easterns. There's far more value in that comparison. So these 2 top-down elements have to be in there. Bottom up, you need to give the details and the analysis of your company, fund, security, etc., so that yeah, literally you can compare the information in depth with that of other cases. And last but not least, you need to have a proper risk management. Like in the situation of investing in a Swiss startup, I need to worry much less about currency risk than in a Turkish startup. And political risk, well, when you are investing in a region where the political situation is turbulent, yeah, it's a different kind of risk management situation than when investing in, let's say, the very calm Western European markets. So those kind of things are important. I mean, this is a little sheet where I then filled in the previous one with our own approach in a kind of example way, saying we look top down to our market climate indicator every 2 weeks. We have data from 1961 onward, and we share them with anyone who wants to hear about it. So at the end of the month, we will update the figures, and then in the first week of January, you can hear where the model is at the moment with the top-down information about the economy, interest rates, the volatility in the market, stock market momentum globally. At the moment, we think that the market is okay, mildly positive, and it's already for quite some time. But yeah, we can, in the sessions that we do there, update you with the trends in the market globally as well as per country, how we see them every 2 weeks. And that should be more than enough for most people. Obviously, we could do it weekly or daily, etc. But why do more when it just eats resources and probably doesn't add much information? We work with our own sector classification. That one is important for a lot of small entrepreneurs. We have created major sectors: consumer goods, energy, metals, mining, industrials, EMI, financials, healthcare, biotech, pharma, HEA, ICT and media, and infrastructure. That's just 6 blocks, and the whole world will fit into one of those major sectors. Why is that? It's more than enough detail, but most entrepreneurs that we meet, they always want to do whatever they can to make themselves unique. But the problem is, when you are unique, I can't compare you. When I can't compare you, I cannot know that you're good. I need to create building blocks where I can categorize you so that I can compare you. And when you're great, you will pop up because you're greater than the average in my building block. But the moment that you're so great that I can't compare you, I won't invest, because then my risk management block will say, hey, we have no information whatsoever about how to judge and evaluate this. Well, then you better not invest in it, right? Countries. We need to distinguish between countries. Is it a big country, a leading country in the region? Is it a large market but not leading? Is it medium size, small size, other size? Why is that important? Example, if I'm in Africa, Nigeria and South Africa are no doubt among the leading markets there. So for investors in those markets, they are different from, let's say, Mali or Sudan, etc. So things are always relative. But for a US-based family office that is afraid of going international, even Nigeria and South Africa might, in their perception, be as risky as the smaller markets, right? Because compared to their own markets, they are risky and small. So this country classification thing is also important. If you are in a risky market and you know that you're in the risky market in a risky business, doesn't mean that you cannot find investor. It just means that you need to go for the investor that probably doesn't mind your type of risk that much because he's used to it. And last but not least, a regional classification is also very useful. North America, Oceania is one that we have together, the English-speaking countries, Australia, New Zealand, Canada, the US, Latin America, Europe developed, emerging Europe, MENA, Africa, Asia Central, and Asia Far East. We invest in all, but we have created blocks so that we can always compare within the region what is missing in our portfolio. What are we looking for? Which region do we not trust that much at a certain point in time, etc. Then obviously the information about yourself, the pitch, the company. Tell us about it. What returns are you realizing? How's your growth rate? Do you pay dividends or not yet? Can we do a valuation? Did you do a valuation yourself that we can use as a kind of first basis for what we think we could, look at? What are your future expectations? Are there analysts out there, or have you done a little analysis yourself? How's your financial health, etc.? Those kind of things, because we need to have these as well to literally then compare you with other cases in our portfolio. And last but not least, the risk management. Don't try to make yourself look less risky than you are. See, risky is fine. I mean, if I don't want to take risk, I can put my money in a savings account and then have a boring low return. The moment that I want to have a higher return, I need to take more risk. So that is fine. But those four elements should in every good system be there. And keep in mind that every serious investor will always think in these four block terms. The moment that you're going to try to communicate with investors with your own, let's say, company related model, and you have all those components in the communication about your firm, maybe in your case it will be just one page about your sector, one page about your market, and then 10 pages about your company, but at least you have them all integrated, updated with a frequency that works for you. Bi-weekly is for me good, but I'm a reasonably big investor in equities, listed and non-listed. And more than bi-weekly, as in weekly or daily, it doesn't work for me. It's too much work and I cannot do my other things anymore. But yeah, monthly could have worked. I just will have a slower, less erratic portfolio movement. So the slower you make it, the more long-term you stay with things in the portfolio. But in the end, you should do something like that yourself and use what is feasible. And always make sure that whenever you start something, that you have an idea about what to do when either it is very successful or when it's a failure. When will you stop doing what you do? When do you quit? Or when do you feel that it's such a success that you can move to the next layer? So that's why we always apply stop losses and take profits. Know yourself. That's also one where, literally, I have the feeling that in terms of the mismatch between the entrepreneur and the investor, this is one that is very, very important. Big and small, for instance. What is big and small for you might not be big and small for the other investor. We see that in our group. I mean, the biggest investor in our group is a Chinese family office, who are the family office behind a listed Chinese large cap company. Yeah, they're very big. They have a portfolio of 5 billion as a family. So whenever they think about splitting up the thing in 1% building blocks minimum, the 1% is already, in that case, a 50 million building block. So if you are far less big than 50 million, they don't find you interesting. That's not because you are not interesting, it's because they are too big. So technically, always know yourself and also know the person or the entity that you're talking to. The moment that it's about your firm long term and you love your firm, what is your goal with it? Do you want to quit as soon as you can sell the firm, or do you want to stay with it? And when I had my startup and got the offer from the insurance company, it was very simple. They said, look, you either sell it to us, the whole firm, or it's no deal. I loved my firm. I didn't want to lose it, but at the same time, my firm was about managing money in portfolios. So the offer to then be part of a bigger entity so that I could think in terms of clients with 10, 20, 30, 40, 50 million per individual client, was tempting. So the idea to say, hey, we buy the firm, but you will stay with the firm and you will then work from within our company on the same things that you were doing was tempting. So I did it. So I went for a short-term sale to a bigger entity. Is that what you want? Or are you the type of person who wants to stay independent and want to grow independently for the long term? Those kind of things are all just as important as picking the right thing. Our advice, how should you see the advice? Well, I'm not an asset manager, as I told you. So we are not asking for money. We have an advantage, therefore, with family offices who know that, the ones in our group and others, in that we share the information together. When we bump into nice deals, we will share it with the group. The deal flow, opportunities to invest in companies that we like. So when we do a valuation, it is for ourselves, because if the valuation is good and we get excited about the firm, we invest in it ourselves. But it's also to share the valuation with other investor members on the platform, because if in some situations a certain deal doesn't fit our group, doesn't mean that you have a bad deal. It simply means that the timing was wrong for our group. But that's why we create the platform and want to grow the group. It's like a club of like-minded investors who like the do-it-yourself approach, who don't want to outsource money as limited partners to asset managers because they don't like to pay a high fee for something that they could do themselves in a diversified portfolio. And the other way around, if you are a company that is in there for the long haul, who doesn't want to take the risk of working with an asset manager that in the end is not so much interested in you, but only in the unicorn in the vintage year that you are selected for, then I think that it's a match made in heaven. So we like to bump into small listed or non-listed companies where we really like the valuations, and then in our group of investors and companies try to bring people together who are a match made in heaven for each other. Financial information, we spoke about it, and I told you that to have some kind of benchmark is good for every company. Also, when you're non-listed and very small, then the small listed micro companies might be a very, very nice benchmark to see, is my return on equity high enough? Do I have enough debt, or do I have too much, etc., etc.? How do you get that information? For a lot of people, Bloomberg is too expensive to have a terminal there. We can recommend Simply Wall Street. It's an Australian financial platform. It's relatively cheap. For a couple of hundreds a year, you can get information about more than 100,000 stocks in some 70, 80 markets. And you can also create then the benchmark that is best for your non-listed firm in your market. So that's also something where, we literally hope that if you want to learn what investors are thinking about, or what investors consider good, reasonable, or bad numbers, you could then, for a little investment, even get your own idea of it. So that's why we share that here. And when you want to, as an investor, invest in practice, make sure you have a good broker. We like eToro, for instance, interactive brokers, and there's also good local ones, because there you only pay for the services you get. So in a way, if there is one thing probably we have in common, it is that entrepreneurs, they don't like intermediaries, but instead they like to do it themselves. We as investors are just like that. We like to do it ourselves instead of giving the money to another intermediary. In case you have questions, you can contact Vlad or join in future sessions. We just hope that the information that we share and the contacts that we're going to share can help you in literally giving you the understanding what the right valuation for your entity is, or the right valuation of entities that you're looking at as an investor, and the other way around, that you meet the kind of party that would literally, for your case, be the best party to meet. Thank you. The floor is yours,
Thanks so
Lars.
much. Yeah, thanks so much, Eric. Well, I guess this was very informational and somewhat in a bit mixed kind of info set for both entrepreneurs and investors, but this is exactly what we are about. We are entrepreneurs ourselves, we are investors ourselves, and we believe that investing in stock listed is something is basic. You know, when you like to enrich yourself as a person or in a setting, in a professional setting, you need to have equities first of all, because this is the biggest asset class in the world. The next big one being real estate, but in the equities you have, I mean, as we distinguish it, at least, you have listed and non-listed. Non-listed is something that is basically not stock listed, and listed is something that is stock listed in any stock exchange in the world. And as Eric mentioned, we use Simply Wall Street for finding those listed guys who are undervalued or overlooked, because at the end of the day, our specialization within our group is those kind of neglected themes or overlooked themes. And this also goes for non-listed. And we like to be part of the equation, or be part of the solution to making markets more efficient. As Eric was saying, you know, efficient markets are those markets where your price is as close to the valuation as possible. And this is something that we like to do, to contribute to within our platform that we have built for entrepreneurs, asset managers, and investors. And we aim for giving a spotlight for those entrepreneurs who feel overlooked or who need some support, some boost in terms of information highlight for their company. And we are happy to share some similar information from today's in today's webinar with other investors, asset managers, and entrepreneurs. And we'd like to build a community, a global community of entrepreneurs, asset managers, and investors, so it can all work in ecosystem just like that, when you can find the right person that you need to boost your financial goals, let's say, with your company or your personal ones, within our platform, within the community. So it's like easily accessible, because oftentimes it's difficult to to open that door of big finance. I mean, it's almost impossible, but we'd like to make things possible.
Yeah, that's a good one, Vlad, because basically, Muriel, see, my situation is a little bit weird, huh? Because I was an academic when I started, and then I became a startup manager because the information wasn't there, and I felt that it would be nice to create it. And then I started sharing the financial information about emerging markets that were neglected at a time when nobody had it. But in the end, I realized, after joining the institutional ranks 5 years later, that there was this enormous gap between not just the markets developed and emerging, but also within countries, between institutional and, let's say, the family office angel investor world. And now when I met Vlad and said, okay, what can we do to bridge that a little bit? Because the problem is, and no doubt, I was the idiot that in my LinkedIn profile said, okay, I'm going to add investor. And I knew it. Why is nobody doing that? Because you immediately get 5, 10, 20 proposals a day. But okay, I don't mind, because I come from the industry. I was an institutional investor, but the other family offices in our group, they would not even think about it. I mean, the moment that I would tell them, hey, there are some companies, would you like us to organize a beauty parade where you will then be present? They said, no way, only when I can do it anonymously. So the end investors come from a place where they don't want to be bombarded with all kinds of deals that don't fit what they are looking for. And then when we had the group, we said, well, you know, the funny thing is, there's a lot more asset managers out there now looking for all kinds of specialties. But the end investors are just as hard to find now as they were 30 years ago. But is that because they are not interested? No. So then I got this crazy idea saying, there is another neglect in the listed markets where smaller companies, micro companies, small companies, let's say the ones below 1 billion US dollar market value worldwide, they all have family offices or big entrepreneurial rich people behind them. So one of the ideas that I shared with Vlad is I said, look, I like small and micro listed. I can sell every day, and there's a lot of mispricing going on. So I like it actually much more than very large companies. But the funny thing is, those companies, they fight for information from the financial press. See, every year I go to all kinds of seminars, and small entrepreneurs, also listed entrepreneurs, they pay 10,000, 20,000 for 2-3 days meeting people like myself on those seminars. And in the end, if there's then one Amazon.com or God knows what other sector giant out there, then they literally almost spent their money for nothing, because all the institutional investors will want to talk with the big guy. And you as a small guy, you just made the day for the conference organizer. So that was wrong. And I said, well, if we are going to showcase the investments that we do as a group, also in the listed companies, then it's very easy for us to invite one of those listed companies if he wants to talk to others. Because the least that can happen, if there's good chemistry with the non-listed members in our group who are so much smaller than this listed guy of, let's say, between 100 and 1 billion market value, you know what we could achieve? A chance with a reasonable probability that the two like each other, and that the one says, hey, I know your sector, you're a nice little small company, why not together bump into each other? Maybe my big company can help your small company, and as a person, because I'm a big guy, I have a big company, I can invest in your company because I like what you're doing. So that in a way we can bridge this gap between angels and bigger family office investors and smaller entrepreneurs, totally surpassing the intermediate layer of asset managers. I have nothing against asset managers, by the way. I'm still part of the community because that was my sector. But I think that for serious small entrepreneurs, the best way forward is to literally find angels and family offices directly. And that's in a way what we try to achieve with the platform.
Yeah, and talking about the platform, let me briefly walk you through what's in there and what it is. So basically, we have a club, which is like an extended version of multi-family office closed club for investors, where we share deals internally with the 11 other family offices within the group. And basically, the extended version, it looks like this. We have this family offices and other investors who are looking to find some nice, either listed or non-listed opportunities in equities. And from the other hand, we have those listed and non-listed opportunities. So basically, what we do, we screen between, within the listed space, we screen them from 150,000 listed companies globally. We screen them. We filter them first of all for Eric's family office as a first initial client, let's say. But then we also share this information for other investors. And the same we do for non-listed. We screen for our investment first, and then we share the deal. If something is not right for us, we share it with the investors, with the analysis, with the due diligence information papers that we shared for the investors. Because there is one thing when you you try to sell yourself to investors as a company founder, where things are overly exciting for you, which is normal and understandable. But then it's a completely different story when you are, as a colleague, sharing critically objective information, saying, hey, these guys are good, take a look at them. It's a whole different game and effect. And basically, So the club is kind of closed at this moment. It's closed for yeah, it's reserved for the investors and for some startup founders that we are slowly getting in, because obviously we like listed, and we going a bit in the non-listed direction, you know, one by one, let's say. But then the procedure to join the club for as a founder is basically you just apply. I will share the link with you. You just apply with your info, and we have a look at it. But the trick is that at this moment, we we start looking at your startup once you are applying as a member, because of the good listed performances, you can understand, because there is a whole new level of risks associated with being non-listed, because you're not liquid, information is not there, and therefore we said that for non-listed we're gonna invest in members only. But then if we cannot invest for some reason because the valuation is not right, or there are tons of reasons, we can always share the information with other investors. And this is already like kind of like a service that one party has to cover this admin fees, let's say. But the idea of the platform is that it is open for all, and the platform is basically a website where you can read the articles. You can sign up for the member-only events. Like this event was meant to be reserved for the future members, but we said no, it's Christmas, whatever. Let's just do it open up for all, and we'll be holding for the we call it basic plan, as you can see when you scroll down on this page. We call it basic because investment, as I said a couple of times already, investment in stock listed companies is a basis for us, and we believe that it should be basis for all.
Yeah.
And within that platform membership plan, you will get access to bi-weekly market climate indicator updates. This is what Eric was saying, that he makes the update of the model bi-weekly, every 14 days, to keep a pulse on the market, to keep the information updated on what's going on in the world. So, you know, basically, you don't have to do it yourself. It's done for you, but then you can apply this done for you for do-it-yourself information in
Yep.
the investment. And then the other thing is regular sector and regional updates. We cover all 6 economic sectors. We just divided all economic sectors that there are in the world to the 6 categories. You can all find them all on the platform. And we do basically the update on what's going on in the sector for the benchmark for you as an investor to see, okay, what is normal in this specific sector, and for you as an entrepreneur to know, okay, what is normal in my sector, objectively, globally, or per region, or per your country. And then basically we will also do monthly live webinars like these ones. But then this particular webinar was it was designed a bit more for investors, as you can tell, or for do-it-yourself investors. And this is I also answered to Kenneth in his question. But then we will have we'll have like specific events for founders, for aspiring founders, for investors, for asset managers, with Q&A session where you can always ask your questions, and we always happy to answer them all. And the idea of One4All platform is also that you can get your particular specific questions answered always. We have 2 ways of you getting answers. One is via our well-trained chatbot named Harry, after Harry Markovich. It's well-trained, but if it's not able to answer your specific question, you're always welcome to hit me up on email, also we will have the Google Sheet file where you can ask your questions upfront before any event. So we prepare the answers upfront for you and for other members. So the idea is that you really get the value from that. Also, we'll have courses on entrepreneurship, investment, asset managers, some corporate and legal aspects of various sizes. It will be like bite-sized courses where you can just 15 or 30 or 1 hour course where you can get education on specific topic that you like to understand, or it will be a bigger courses like several months, or the biggest is 9 months complete entrepreneurship or investment course where you get all the information you need to become great entrepreneur or investor or asset manager. But then as a basic member already, you are entitled for very nice discounts for the bigger courses, because the smaller courses will be included in the basic membership, but then the bigger ones, of course, are to be paid. But with the basic membership, you get nice discounts. And of course, you will be, the aim is to build a community of investors, entrepreneurs, and asset managers globally. And basically, you will already become a community member of other fellow investor, entrepreneur, and asset manager. And as a bonus for new members, only like now, let's say, we'll also include the stock ideas and insight. Basically, we run once per month a company of the month awards that we award for listed guys. And also we are planning to do the same for non-listed companies. And basically we have like vetted non-listed and listed companies that you will have access to see if you like them to include in your portfolio. This is for investors. And for non-listed, it's good news that like we'll create events to highlight you as a non-list. So as a startup founder, we'll highlight you with other investors on the event where you will be pitching to other investors, real ones interested in your thing. How does that sound? I mean, is it like normally you need to chase them, but then we will make it possible where you are presenting, and some real investors that are interested in your sector or in your industry will be listening your pitch. So this is oh yeah, and also because it's Christmas and because we are launching it softly, let's say, I have a gift for you, which is basically a 50% discount on the basic membership. If you like it, I will share with you a promo code that you can use, because as you see on the, let me share a screen with you very fast. So when you click on that link that I shared with you, so you go to the club membership page and you scroll down a bit on the packages. So you can choose here quarterly or annually. So as I said, premium and VIP is reserved. It's not for purchase only. It's a vetting process. But today we're talking about basic. And basically, if you hit the get in button, you will see this thing. And if you click the promo code, and the promo code is, let me share it with you. How do I do it? I want only the webinar attendees to be able to use that. to be fair, but let me probably share it with you in chat. Let me just give me 1 sec. Yeah, can I get it? Boom. If you type in that promo code with the capital letter thingy, and you hit submit, you will have a 50% discount on the time frame that you choose, either quarterly or yearly. I recommend yearly if you ask me, because we'll be adding more and more content that you will benefit from. And we'll build new features like matching mechanisms with angel investors or with startups. So entrepreneur investor or opportunity investor matchmaking, and we'll also enlarge our database of courses, of all article materials and events, where you can screen them and search them with hashtags, which will be very interesting and very useful. So, and a lot of things coming more. So yeah, this is how you join. If you have some questions regarding joining the platform, or regarding the webinar, please feel free to unmute yourself, and happy to take